Hello, I'm Kim Parley, and I'm here with Bruce Cooper and Ken Miner, who are co-chairs of the TD Wealth Asset Allocation Committee, which provide guidance to over $300 billion in assets managed by TD Asset Management. They have just come out with a new paper, Forward Perspectives, part of the regular paper that comes out, but the title is A Return to Normal. So here to explain what that means, I'm joined by Bruce and Ken. Nice to see you both.
Great to be here.
So you, in this paper, outline basically some things are the same and some things are different. So let's start with what's the same, and it's the theme we've been talking about, Ken, for a long time, debt.
So for some considerable time, what we've had is the view that during that financial crisis, debt in developed and developing worlds reached a level that it was going to constrain economic growth for some persistent period of time. And whenever growth is constrained, we look at that as having lower returns than historically. But within the valuations that we were seeing and the very low coupons on bond, we had a huge preference for equities over fixed income. Mm-hmm. In addition, an overweight in corporate debt over government debt. And that's very much still a theme that's intact today.
Right. Still lots of debt out there.
Lots of debt out there.
That has not
still
gone
going
away.
to constrain growth,
Yeah.
etc.
Okay, let's talk a bit about then, if that's what's the same, what's different? What are you seeing that's causing you to have this shift, which we'll get into?
Yep. So, of course, one thing that's different is the price of financial assets. Since the crisis ended 6 years ago, S&P 500 has tripled, the TSX Composite has doubled, and that's really been driven by a couple of big tailwinds. We've had double-digit earnings growth, and of course PE multiples have also expanded. That's been a great double whammy. It's given you fantastic returns on stocks. Our perspective from here is that those tailwinds are going to dissipate a little bit. We still think you'll get earnings growth, but probably more like single digit, and the multiples are probably going to be more stable. So you're going from strong tailwinds to more muted tailwinds. We think an environment of more muted returns, think mid-single digits. At the same time, we think we could be entering an environment where volatility rises. And that's after a period of very low volatility, which we've been in for some time. And so more muted returns, higher volatility, a more difficult experience. But really, this is not a pessimistic outlook. It's really just going from a very optimistic outlook to a more normal environment going forward for the next few years.
And part of it, to your points, I know, is just the fact that it's what we've been used to in the past little while. So things will be reverting back to a mean just we haven't seen in a long time.
That's exactly right.
You actually have a pretty fun analogy in here, a gastronomical analogy, cooking on talking about what normal looks like. So go ahead. Chef Ken, tell us what you're talking about here.
Well, you know, all investors have different risk profiles, and you'd imagine that a more risk-adverse investor would have a less risky profile, and you imagine somebody that's quite ambitious could have a high-risk profile. But one analogy we like to use is we all like to eat.
Yes,
so,
some more than others, myself.
Right.
But
so imagine you had all of the cookbooks that you could imagine lined up on a bookshelf, and they were arranged from very bland meals all the way up to really spicy meals. And of course, when you're just feeling good and normal, you choose from the middle of that book to cook something you like to eat. Well, for some time, we've preferred to kick it up a notch. So we've been choosing a cookbook from the far right hand of that range. And all we're saying is we're looking to bring it back more to normal kind of diet, normal kind of spice. And that's kind of what we mean for Investors Day and return to normal. Rather than taking on a lot more risk, we just want to bring it back to the middle of your range. Because what we find is over time, the risk inherent in financial assets is never just one number. It's a range, just like the range of cookbooks. So we're back in the normal
back to
part.
the middle cookbook. And from what I hear what you're saying too is the risk doesn't look as though it's going to get the same kind of reward in the future too. So tell me, for someone who's listening, what does this mean for investors? What do they need to do with this information that we're talking about?
Yeah, so the great American investor Warren Buffett talks about being fearful when others are greedy and greedy when others are fearful. And so if you went back to 2009, 10, 11, people were fearful. Yeah. And so it was good to take that risk, kick it up a notch, as Ken talks about. We wouldn't say people are very greedy or over-optimistic today, but it's gotten a little more frothy, back to normal. So our ask is for people to take a fresh look at their portfolios, and if you're taking more risk than you think would be normal, maybe dial it back a bit, really reassess your portfolios to ensure that you are comfortable given that we would expect returns to be more muted with higher volatility in the next few years.
Bruce, thanks very much.
Great.
Ken, thank you. Bruce Cooper and Ken Miner, both co-chairs of the TD Wealth Asset Allocation Committee. I'm Kim Parlee. Thanks for watching.